Well, joining us now is Henry van Deventer, financial planner at Acsis, for some more Investment 360. Henry, you are saying that investors make the big mistake of getting more conservative the closer that they get to retirement.
Bronwyn, very true statement for two reasons. I mean, what we firstly see in South Africa is, as in the rest of the world, our brains are wired for fear more than they are for greed. And what studies have shown us is we react about twice as emotionally to losing money as we do to making money. And one of the mistakes that we make as a consequence of that is, as retirement starts looming near and starts approaching, we tend to think, well, I need to be safe here. I can't afford to lose any money in the markets, and we start going conservative. And to make this even worse, what a large number of the pension fund and retirement fund companies out there do is they provide us with these life stage portfolios that we invest in that kind of automatically gear you into sort of cash or something similar to cash for those 3 to 5 years prior to retirement so that you can be safe. But in fact, it's one of the worst possible things that we could be doing.
But it depends on your age of retirement as well, because there are government employees who retire at 63 because it's mandatory. And then there are those entrepreneurs who retire at 75. It's a huge 12 years is significant, and I mean, you could argue that people live to 80, 85 now. But
well, apparently, the first person that's going to live to 140 is around about 40 years old today. Just to put that into perspective.
This is some really scary numbers. In fact, this really forces us to rethink altogether how we want to draw income off our retirement strategies, etc. Although, Ashraf, I'm not quite sure if I agree with you on your point. Whether we be 63 years old or 75 years old before we retire, now the bottom line is, at some stage of our lives, we want to be in a position where we can live off our capital if we should choose to. And more and more, if you look at baby boomers nowadays, they'll probably never retire. They'll stop working the day that they stop living. But the reality is, for us, more and more the thinking around retirement planning has become around planning for financial independence. Now, if we're going to use that as a background and as a backdrop, most of us want to be financially independent as early as possible, as soon as we can possibly be. Now, if we start throwing some numbers at what this thing means, well, from a retirement planning perspective, for roughly every 5,000 Rand per month worth of income that I want, pre-tax, the day that I retire, I'm going to need about R1 million at retirement, or at the point where I'm financially independent. Scary thing, if I'm going to live until age 90, if I'm going to live for 30 years, that 5,000 Rand per million starts dropping to 3,700 Rand per million. So with this as a background, how on earth do we bring that back to my retirement strategy or my investment strategy prior to retirement? Well, the numbers tell us quite an interesting story here. If I, for example, have got 5 years to go to retirement, or 5 years to wanting to be financially independent, I've got a retirement portfolio of about R2 million, which let's say for a 60-year-old is reasonable. I'm earning 500,000 Rand per year. I'm saving 15% odd per annum into my retirement fund. If I migrate to cash, my R2 million in 5 years' time is going to be worth about 3.2 million Rand. If, however, I stay in a fairly aggressive market-based strategy, instead of 3.2 million Rand, I would have 4.2 million Rand, which equates to, well, if you're going to live until age 80,
Henry,
an extra
we've got to stop
grand.
here. It comes back to the risk element. There's uncertainty in the global environment right now. The discussion that we were having a minute ago was, are those surveyed in the financial services sector by PwC, are they looking into potentially a global financial crisis too? People weren't going that far, but it certainly wasn't out of the picture that we could see some dire activity coming down the line.
We could. And if we look at the last 3 or 4 years, going back to 2008, 2009, certainly we did. What markets show us, though, historically is one out of, if you look at the last 100 years or 87 years, 1 out of every 3 years you're going to lose money. And you're going to go through...
But now comparisons are being drawn with Japan in many different economies and many different markets. There you don't see a recovery. And then you would be in serious trouble if you had upped your equity exposure. And we see a Japan-like scenario panning out. Wouldn't you, or am I being too dramatic?
No, I'd say, in a sense, you're being too dramatic when it comes to the South African context.
Yes.
If you were sitting in Europe, I would say I'm in agreement, and I'd say just an exposure to European equities would certainly drag you lower. But, the Japanese weren't only invested in Japan. They were invested all over the world. I mean, huge investments in the US in the late 80s, early 90s. So the wealth effect was or the impact on wealth was fairly marginal. It was really those companies that had borrowed too much and had asset values decline. I mean, there was a property company in Tokyo whose entire portfolio was worth the value of land in California. Now that was, got to the point of ridiculous.
Let's come back to South Africa. Do you agree with Henry's thought process here?
I'd agree with his thought process. Right now we're going through a very volatile time, but ultimately you will get real growth in assets.
Right, so go back to sharing your stats with us.
Well, before we look at the stats, let's pick up on Ashraf's thought, because we're going to look at risk and how we define that. What we tend to do is we tend to be very myopic and very short-sighted in terms of defining the potential for equities over the next year or 2 years. But if you're going to look at this as a 5-year story and as a 7-year story, then suddenly the considerations become quite different. So firstly, what is risk in the short term isn't necessarily always risk in the long term. And if I'm going to plan for my long-term investment strategy, I need to look at long-term asset behaviors. Although the short term might be very, very uncertain, the bottom line is if I'm intelligent about how I manage, especially my retirement fund money, instead of looking at a sort of age-rated life stage portfolio that makes me more conservative, it starts making a great deal more sense to actually look at an active asset allocation strategy that identifies those pockets of growth and excellence, not only in the South African economy, but in the global economy. And by the way, with recent changes in pension fund legislation, we now are able to get much more exposure to global assets, to private equity and other asset classes that provide us more growth. So what is the bottom line here?
Can I ask you something?
Yeah.
I mean, when you talk about a conservative asset allocation, what are you speaking about? Are you speaking about 40% equities, 40% bonds, 20% cash, or is there a different mixture?
Well, inside of the pension fund space, on the very aggressive side of the scale, you're looking at about 75% exposure to equities. There's some global exposure, etc. So that's the aggressive side. Should be good for a real return of about 6% or so over time. Now, on the conservative side, especially what we see with the life stage portfolios, we see cash, bonds, sort of fixed interest type strategies dominate.
So making up almost 75% of the portfolio.
Making up 75% or more, in a great many of these life stage strategies out there. And if you don't
and hardly any equity exposure at all.
Hardly any equity exposure at all. Now, in the last 5 years prior to retirement, this is when you've got the most money to provide you with the most growth. Why would you, consciously or unconsciously change your strategy in such a way that you fail to achieve that at all?
But now, if you look at performances of sectors, you look at bonds and equities. Over the 10 years to end 2010, bonds outperformed equities. Over the 20 years to the end of 2010, bonds outperformed equities. So I would disagree with the bond asset allocation. I'd agree with you when it comes to cash allocation, because I don't think cash should be anything more than 5 to 7.5%. Drawing down upon requirements from either equities or bonds. I don't know how you feel about that.
Well, I agree with you on the fact that sometimes there will be other asset classes that outperform South African equities or global equities. And I think we're living in a period now where certainly evidence would suggest that that might happen over the next few years. What I am suggesting is it's not as much to focus on overweight equity exposure as it is to focus on an overweight growth mandate inside of how I manage my retirement assets. This suggests a couple of things. Firstly, I need to consciously decide how I want to manage my asset allocation. And if my investment manager isn't focused on giving me exposure to those asset classes at the appropriate time that are set to give me optimal growth, I'm going to end up paying a significant sacrifice in my retirement income once I'm no longer in a position to have the luxury of choosing a more aggressive asset allocation.